IFRS is an acronym for International Financial Reporting Standards. I would like to talk about the history of that standard. In the 70s, there used to be a committee called International Accounting Standard Committee. The committee was actually issuing accounting standards called IAS. But one thing about this standard is that they were not globally accepted. So different jurisdictions, different countries still have their own local standard. In Nigeria, for instance, then we used to have the Statement of Accounting Standards, which we used to use. Now, in the early 2000s, precisely in 2001, a board was formed called International Accounting Standard Board. Now, this board now came up with new set of standards called International Financial Reporting Standards. So, meaning that the committee was abolished, then a board came over. Now, that board is now the one that now started issuing International Financial Reporting Standards. In 2012, Nigeria as a country adopted the standard. And FRC has been ensuring compliance. As we speak today, we can beat our chest that a lot of, more than close to 100% of all the entities in Nigeria are complying to that standard. Now, what is IFRS standard? What is it all about? The standard has been issued to encourage, to promote transparency, to promote comparability, and to also boost investor confidence. So that if you're an investor in any part of the world and you are considering investing in Nigeria and you pick up a financial statement that has been prepared in line with IFRS, you will have some level of comfort, some level of confidence in the way the financial statement has been prepared. There are different IFRS. I will only talk about just one of them today. The one I would like to talk about today is called IAS number 16. IAS number 16 has a title called Property, Plants and Equipment. Now, what are property, plant and equipment? They are non-current assets. When you say an asset is a non-current asset, that means it can be used for more than one accounting period. Now, these assets are used for manufacturing, for production, for service rendering, and also for rental, and also for administrative purposes in the ordinary course of business. If you have an asset that belongs to that category, then you can say that you have an item of property, plant, and equipment. Now, the standard now goes further to say this, that when you have an item of PPE, you bring it into your books. In the first year, that is the year you purchase that asset, you are expected to bring it into your books at the costs. That's when you talk about the model. We have two models. We have the cost model, and we also have the revaluation model. Now, in the first year, the year you purchase that asset, you recognize it using the cost model. Now, when you look at the cost model, it gives us the definition of the cost of an asset. To somebody who is not an accountant, the cost of an asset to him is just the amount he spent to purchase that asset. But accountant will tell you that it goes beyond that. So the cost of that asset is the purchase price agreed, plus what we call directly attributable costs. What are those directly attributable costs? There are other costs that you need to incur for the purpose of putting that asset in the position whereby it is available for its intended use. Now, let me give an example. You purchase a machine from the US and you are bringing it to Nigeria. For it to get to Nigeria, you have to incur cost of transportation, freight, insurance, custom duties. So all those incidental costs that need to be incurred, they are part of the cost of that asset. It didn't stop there. If you need to do installation of that asset, the installation cost is also part of the cost of the asset. It didn't even stop there. Borrowing cost. If you have borrowed money from bank to purchase the asset, the interest element of that loan is a cost. You need to capitalize it. It didn't even stop there. You now consider what is called decommissioning cost. What I mean by decommissioning cost is this. If there will be a need for you in the future to decommission that asset, then right from day one, you need to know how much will it cost the organization to decommission it. You now convert that cost, which will be incurred maybe in the next 10, 15 years. You now get the present value of that cost and add it to the cost of that. Then you say you know the costs. That is in the first year. Now, in the subsequent year, that means from year 2 up to the end of the life of that asset, you have to you have to choose between two different models. You have the cost. You can continue with that cost model if you wish, but the standard permits you to opt for what is called revaluation model. In some jurisdictions, when I say jurisdictions, I'm talking about countries in the world. In some jurisdictions, the revaluation model is forbidden, but in Nigeria, we allow it. Now, what the revaluation model is saying is this. In year 2, you now call another expert, who is not an accountant, they call them valuers, to come and do valuation of that asset. So you now bring it into your book at the fair value. Consider the accumulated depreciation and the accumulated impairment loss before you now know the carrying amount of the asset. So the asset is already in your book. Then we need to actually discuss what are the concepts that surrounds IFRS 16. Let me start from depreciation. To somebody who is not an accountant, he believes depreciation is just wear and tear. But to an accountant, depreciation goes beyond wear and tear. Depreciation was defined by the standard as the systematic allocation of the depreciable value of an asset over its entire life. The standard does not say you should use a specific method to compute your depreciation. In accounting, we have different methods. We have the straight line, we have the reducing balance, we have the sum of the year digit, we have the machine hour. What the standard says is this: use a method of depreciation that reflects the pattern of consumption of that asset. That is to say, you use a method that shows the way you are using the assets. So if you have a motor vehicle and what you do is just to drive it once in a week, then you can choose to use straight line. But if you have a delivery van that is going out every day, 24/7, every day of the week, the van is on the road, it will be unfair for you to depreciate it using straight line. Then you can now consider another method of depreciation. The beauty of IFRS standard is that it is principle based. It allows the users to use judgment, to use their initiative in arriving at certain decisions. It's not rigid. It's a very, very flexible standard. Now, another concept that we need to actually look into that comes in also under IFRS 16 is impairment. Although there is another standalone standard that addresses impairments, which is a topic for another day. The simplest definition of impairment is just a loss in value of an asset, although there are some other technical definition of it. But for the purpose of this podcast, let's just take it as loss in the value of an asset. So when you are trying to arrive at the carrying amount of an asset, don't forget we started by discussing either you use the cost or revaluation model. So whichever one you have chosen, that is after year 2 onward now. If you have chosen the revaluation, then the carrying amount will now be the fair value less accumulated depreciation, less impairment, if any. If any, in the sense that it's not in all cases that you have impairment. Now, let me quickly talk about the concept of componentization. This is a new concept. In the days of statement of accounting standard, we don't used to have componentization. But research has proven that there are cases whereby you have assets that are big enough to the extent that they have different components. And each of those components, the value of each of those components is so significant. So you cannot afford to allocate the same useful life to the entire asset. For instance, let me give an instance. It's used commonly in aviation. If you look at aircraft, some aircraft have 2 engines, some even have more than 2. The engine alone, the value of that engine alone compared to the value of the aircraft, the value of the engine alone is so significant. So if you now say the useful life of this aircraft is 20 years, there won't be fairness, because before the end of 20, by the end of 20 years, some of those components are still in good condition. So the standard now say what you do is that you componentize them. You can now classify the engine as a component that will have its own useful life, its own method of depreciation, the other engine also, the body, and other component of that asset. And that is one thing, one improvement that the IFRS standard has brought into financial reporting. Now, let me also like to talk about the idea of revaluation surplus and revaluation deficit. Don't forget, I said earlier that the standard allows you to use the fair value approach. So, and when you use the fair value, you have invited a valuer to come and value the assets. The value that valuer is going to give you will either be higher than the initial value of that asset or lower. That difference will be a surplus or deficit. What does the standard say? It says if it is a deficit, take it to your P or L. That means any item that goes to your P or L will definitely affect your profit for the year. Now, if it is now a surplus, don't let it go to P or L. Let it go to other comprehensive income. Any item that go to OCI will not have any impact on your profitability, but it will affect your reserve because it's going to eat your equity. Now, the fact now is this. When you revalue and you have a revaluation gain and it has gone to OCI, now if in the following year you have a revaluation deficit, the standard allows you to use the revaluation gain that you already have to net off that deficit. And well, that's exactly what the point of the idea of revaluation is all about.